11. Never do this mistake in investing money. Investing in the stock market can be a tricky game, and if you're not careful, you may make some grave investment mistakes that could cost you a lot of money. First-time investors are habitually too eager to jump right into the investment game, and quite often do not commit to learning from the mistakes of others. Fortunately, by taking the time to get to know the common investment mistakes most investors and traders are prone to, you can ensure that you avoid making those costly errors. 1. Not understanding the investment. One of the world's most successful investors, Warren Buffett, cautions against investing in companies whose business models you don't understand. The best way to avoid this is to build a diversified portfolio of exchange-traded funds, ETFs, or mutual funds. If you do invest in individual stocks, make sure you thoroughly understand each company those stocks represent before you invest. 2. Lack of planning. Seasoned investors tend to have a plan based on facts and figures. First-time investors, however, often give into the guessing game and blindly invest in stocks that appear to be performing well. The downside to not having a proper plan in place is that you have no end goal. And as a result, your investment pattern can be quite erratic. This, in turn, could turn you into a reckless investor, resulting in greater losses if you're not careful. How to avoid this mistake? The simplest way to keep yourself from making this investment mistake is to take some time to chart out a financial plan before you begin investing. Identify your goals and pick a strategy. Look into the financial data of companies you plan to invest in, and make informed decisions as opposed to blind guesses. 3. Personal bias. Beginners trading in equity are prone to allowing personal bias to drive their investment decisions. For instance, many first-time investors tend to either only buy companies they know or companies they like. This is clearly not the best way to go about investing or trading in equity, because companies you know or like may not always be the ideal investment options for your risk profile or your financial goals. How to avoid this mistake? One way to avoid allowing personal bias to rule your investment decisions is to focus on research and obtain financial information about the companies that you're interested in. Research-based investing can help you overcome any bias you may possess, so you can make unprejudiced and informed trade decisions. 4. Refusal to cap losses. Beginners also tend to hold stocks and financial assets even when they're not performing well. If a stock's value is plummeting, many first-time investors and amateur traders are prone to refraining from selling the asset in the hope that its value would shoot back up in due time. In most cases, this may never happen, leaving investors with significant losses that could erode their capital greatly. How to avoid this mistake? You could set a limit for losses, beyond which you will have to sell off a loss-making stock, thus limiting your capital erosion. Many trading platforms come with a specific stop-loss feature exclusively for this purpose, so you can set a specified price at which to sell your loss-making stock. 5. Short-term focus. The idea that investing in financial assets or trading in equity can make you get rich quickly can often limit your focus to the near future alone. This stops you from thinking about the long-term effect of your investment decisions, and that could be extremely damaging to your financial future. If you want to see full video, click here to watch. If you like this video, please share with your friends and family, subscribe for more videos like this. Thank you for watching.